Hey everyone, and welcome back to the channel where we demystify the markets and explore unique trading opportunities. Today, we're diving deep into a fascinating hard-to-borrow situation with a stock that's caught our screeners' attention, HCWB. We're going to break down exactly what makes this micro-cap stock stand out, explain the mechanics of short squeezes, and discuss what these unique metrics might mean. Stay tuned, because this one has some truly eye-popping numbers. Important disclaimer, this video is for educational and informational purposes only. Nothing in this video constitutes financial, investment, or trading advice. Always do your own research and consult a licensed financial advisor before making any investment decisions. Past performance does not guarantee future results. Show company logo / stock ticker. Let's jump right into HCWB. This is a microcap stock, which means it has a relatively small market capitalization. Interestingly, the sector is listed as N/A, which is quite uncommon and often points to a company in a very niche area or perhaps one undergoing significant changes. Now, looking at recent price action, HCWB has shown exactly zero movement, plus 0.0% today, plus 0.0% over the last 5 days, and plus 0.0% over the last 30 days. Similarly, recent volume has been as zero shares both today and on a 30-day average. Despite this current dormancy, the hard-to-borrow characteristics of HCWB are extremely significant and precisely why we're discussing it today. What is cost to borrow and why it matters? So, what exactly does hard to borrow mean, and why should you care? When you want to short a stock, you first need to borrow shares from a broker. Just like borrowing money, there's a fee involved in interest rate. This is called the cost to borrow, or CTB, and it's typically expressed as an annualized percentage. When a stock becomes hard to borrow, it means there's high demand from short sellers to borrow its shares, but very few shares are actually available to lend. This scarcity drives the CTB fee sky high, sometimes even well over 100% annually. A high CTB indicates that short sellers are willing to pay a hefty price to maintain their short positions, signaling either strong conviction in their bearish thesis or a desperate need to cover existing shorts. Why this stock is hard to borrow right now? Show screener data graphic. Now let's look at why HCWB has landed on our hard-to-borrow screener. The annualized cost to borrow fee for HCWB currently sits at an astonishing 544.6%. Think about that for a moment. Thus, over 5 times the value of the borrowed shares per year just to keep a short position open. What's even more telling is the CTB momentum. It's dropped by 135 percentage points over the last 5 trading days. This doesn't mean the rate itself dropped, but rather that the availability of shares tightened so much that the momentum in the cost to borrow indicates rapidly shrinking supply. Currently, there are only 90,000 shares available to borrow for HCWB. When you compare that to the estimated float of just 1.6 million shares, you can see why this stock is considered extremely hard to borrow. Our internal composite squeeze score for HCWB, which factors in CTB level, momentum, borrow supply, float, and technicals, currently stands at 43.8 out of 100. Squeeze mechanics explained. Show animation of short squeeze process. So, what are the mechanics of a short squeeze? It starts when a stock has a high short interest and a limited number of shares available, just like HCWB. If something positive happens, or even if short sellers just start feeling the heat from those sky-high borrow fees, they might decide to close their positions. To close a short position, they have to buy back the shares they borrowed. If many short sellers try to buy back at the same time, and there aren't many shares available on the open market, especially with HCWB's small 1.6 million share float, that sudden buying pressure can rapidly drive the price up. This price increase then triggers more short sellers to cover, fearing even greater losses, creating the cascading effect known as a short squeeze. However, it's crucial to understand that a high cost to borrow does not guarantee a squeeze. It can also mean that short sellers have incredibly strong conviction that the stock price will eventually fall, and they are willing to pay steep fees to wait it out. Dilution risk check. Show SEC filings graphic. One major factor that can completely negate a short squeeze thesis, even with high borrow fees, is dilution. Dilution occurs when a company issues new shares, increasing the total number of shares outstanding. This influx of new shares can provide short sellers with an easy way to cover their positions, increase the float, and effectively kill any upward price pressure from a squeeze. For HCWB, our check revealed good news on this front. We found no recent dilutive SEC filings like SMINUS1s, SMINUS3s, or 424Bs in the last 90 days. Furthermore, there have been no recent reverse splits for HCWB in our look-back window, which can sometimes precede or be related to financial distress. Important disclaimer, this video is for educational and informational purposes only. Nothing in this video constitutes financial, investment, or trading advice. Always do your own research and consult a licensed financial advisor before making any investment decisions. Past performance does not guarantee future results. Given HCWB's current lack of trading volume and price movement, the key thing to watch for would be any change in this dormancy. If HCWB were to suddenly see an influx of trading volume, even small amounts, it could rapidly ignite interest given the incredibly tight borrow situation. Keep an eye on the number of shares available to borrow. If the 90,000 number drops even further, or if the CTB rate continues its upward pressure beyond 544.6%, it indicates an even more constrained supply. For a short squeeze to really take hold, you typically need a catalyst that spurs buying interest, forcing those short sellers to begin covering. Show HCWB ticker one last time. So, while HCWB currently sits in a unique state of zero trading activity, its hard to borrow profile is impossible to ignore. An annualized cost to borrow 544.6%, only 90,000 shares available to borrow against a 1.6 million share float, and no recent dilution risk create a truly exceptional, albeit currently dormant, setup. Remember, a hard to borrow status flags potential, but it's not a guarantee of a squeeze. It's an interesting case study in market mechanics and the extreme cost short sellers sometimes incur. We hope this deep dive into HCWB has been educational. If you found this information valuable, please hit that like button, subscribe for more unique stock breakdowns, and let us know in the comments what other hard to borrow stocks you'd like us to cover next. Thanks for watching, and we'll see you in the next video.